just to give you an example of how portfolio management has evolved over the years in the traditional asset management world. So I think that the shareholder base holding the Mag 6, they have gotten so used to cash hoards and massive free cash flow generation that this is a big shock to them, seeing these hyperscalers take their capital spending budgets up 100% in 1 year. I think Amazon announced it would go from roughly $90 billion to $180 billion next year, or this year, 2026. That's shocking to people. And we're seeing some of the Mag 6 raising debt even. That has been anathema to this group. So we do think we're seeing a shareholder turnover, not massive because of what I just described about benchmarks. But we don't think necessarily that they are doing the wrong things, meaning the hyperscalers. We think Google is doing the right thing. And all of the Amazon, all of the spending we think is the right thing to do. But this is not what traditional portfolio managers who are benchmark sensitive are used to grappling with. We grapple with it all the time. So you can see here that data center system spending growth was really mid-single digits at an annualized rate for many years, and it kind of stayed in the $100 to $200 billion range until the ChatGPT moment. And since then, you've seen a compound annual rate of growth at 29%. I think with the announcements today, 100% in 1 year, we're moving into overdrive. Now, you can see from our forecast that we've been expecting a 30% compound annual rate of increases since 23. And I think if we were to push this forward to 25 now and do a 5-year CAGR, it would be in the 25% range. So these recent announcements certainly are proving this forecast right. And then you can see, just to throw in another perspective here, we also see that the chip market is going to transform or evolve, I should say, in the next 5 years, a little bit from GPUs taking share to ASICs taking share. And so we've highlighted that there could be a shift from the likes of NVIDIA's chips, AMD's chips, to Broadcom's chips. Now, we think that there's going to be a massive appetite for all chips, but did want to highlight this share shift as well, much like we highlighted the shift away from SaaS toward platform as a service. This spending, is it justified? This chart, it highlights the technology revolution investment cycles here. And you can see the railroad in the 1800s. Railroad spending as capital spending as a percent of GDP got into that 5 to 6% range. Then you go to the automobile in red there, but we have multiple platforms evolving at the same time, and this is additive. So maybe with telephone, electricity, and the automobile, we would see capital spending up at that, cumulatively, up at that 5 to 6% range. And then you get to the internet, the tech and telecom boom, and you can see it looks like it pales in comparison to those other two. But we do have an additive situation going on here. And you can see that adding all of those together is maybe the equivalent of just the automobile cycle in the early 1900s. And then here we are. And we believe these are our forecasts, and they have been our forecasts. And we haven't changed our forecast in the last year. But we've got something additive going on here as well that could accumulate to 12% or more of GDP. Now, just to give you a sense of, or some perspective, I remember in the bubble, telecom equipment spending on the part of some providers got up to 25% of GDP. And as I always say, too much, too soon, and we ended up with a lot of dark fiber. It didn't go live for a very long time. One thing we can say about this cycle is the demand for GPUs is voracious, and they are landing in these data centers, which are saying, we need more capacity. We need more chips. Those GPUs are not dark. And I'm stealing that from Brad Gerstner at Altimeter. I thought that was a very good analogy. The fiber went dark. GPUs are alive. And there's a big scramble for them. Now, the risk here is, and, you know, I have an economics background, and I'm always looking for those risks. Whenever I hear the word shortage, I usually believe that there's going to be a glut, an inventory glut at some point. And I'm sure there will be in the chip space, but I don't think it's going to be for a long time. You need to listen to Elon Musk, who's talking about chips and power as, you know, for as far as the eye can see, being in short supply. And now that he's thinking about putting data centers into space, perhaps even more so. So on this next chart, this is getting to investors. So you can see on the left here, the tech sector capital spending as a percent of GDP. And you can see that it has gotten up to bubble days. And that's a little bit unnerving to investors. And here's why. Many of the most seasoned investors today were very young when the tech and telecom bubble took off. And now they are the gray hairs. And I'm friends with a lot of them. And many of them are saying, been there, done that. I'm leading this organization now, and I'm going to protect it from this bubble. And we understand that. But as I just described, we have really just started this journey. And we expect the capital spending cycle to go much further for much longer. And the reason is the technologies are ready. You know, back in the 90s, we didn't get the cloud even until 2006. But there were visions of, you know, eyeballs in 10 years being the source of valuation today. We didn't get the cloud till, or back then, we didn't get the cloud until 2006. We didn't get the first big breakthrough in AI until deep learning, ImageNet, in 2012. Even bigger and more profound transformer architecture in 2017. And even off of that, we didn't get ChatGPT, the aha moment, until the end of 22, early 23. So we have just begun this journey. Now, one other difference, very important you can see from this chart, is the valuations today are much different than they were at the peak of the bubble. So the dashed line there, you can see is the valuation of the Mag 6. And you can see how crazy the valuations did get at a time when the technologies weren't ready and the costs were too high. So the multiples being paid today are nothing like back then. And in fact, since this chart was done, the multiples have dropped even lower because it is the Mag 6 and fears around what are they doing with all of this capital spending. Return on invested capital is going to go down. That's why I own this stock. And that's why a lot of quants or quantitative research is a little bit, I would say a little dangerous here because a lot of it's momentum driven. And here we are, there's a great disruption taking place called AI. And these companies must invest in it if they want to remain relevant, and they must seize the moment. But short-term oriented shareholders don't really want to hear that. Crypto. Here, I think the disconnect, and this is also from Big Ideas, is, hey, look at what the gold price has done in the last few years, and look at what's happened to Bitcoin. Now, this is a log chart, so you can see gold has had a massive move to the upside. This chart ends at the end of 25, and of course, I think last night we got down to roughly $60,000 in Bitcoin. So really cut in half since its peak in October. What is going on here? Isn't Bitcoin supposed to be digital gold? If it's digital gold, why isn't it behaving like gold? And a couple of points to make here. If you do the correlation between Bitcoin and gold, their returns, since 2019, and I put this in my New Year's letter. You can see the matrix there if you'd like. The correlation has been 0.14. One is perfect correlation, and here we are at 0.14, very low, almost no correlation. So that is very important to understand. What you can also see here, though, is gold tends to precede a big move in Bitcoin. You can see the circles there, and we'd have a gigantic circle around what has happened recently. And so maybe that will happen again. We actually think it will. I cannot tell you how many bear stories I've heard about Bitcoin in the last few weeks, last few months. And just go on to X and you'll find all kinds of reasons why you must sell Bitcoin. And these are the periods that are kind of interesting. We post our trading at the end of every day, and you'll see that we had been nibbling at our crypto-exposed stocks. We didn't know how far this was going to go. And maybe it's not over, not promising that. But there was so much negative sentiment that I felt, okay, we need to leg in and lean into this. If our research is correct, that this Bitcoin is 3 revolutions in one. It's a global, digital, private, very important, rules-based, even more important, monetary system. And that's a very big idea. The second revolution is it is a technology. It's a new technology. It's really adding another layer, I would say, to the internet, so that we have native currencies native to the internet that will be able to handle agentic commerce, and other such agentic movements taking place out there. That's a very big idea. And then, and it won't be, of course, just Bitcoin. It'll be Ether, importantly Ether, Solana, maybe Hyperliquid. We shall see. But what's interesting about this period is the big three have been identified. And those are Bitcoin, Ether, and Solana. You know, the worry historically has been, how many of these things are there going to be? Is this going to be a very fragmented situation? And we're learning we're learning who the big winners are going to be, who the big winners are. And I think that's a very important. And then the third revolution is, this is a new asset class. Bitcoin is leading the way. It is the most secure of all the cryptocurrencies out there, backed by the largest computer network in the world. And so really an anchor to an asset allocator looking to move into this new world. And why would an asset allocator do that? Well, if we're right, and well, it's a fact that at least over the last 5 years, the correlations have been the correlation has been as low as 0.14. The key to successful diversification for asset allocators is adding new assets with very low correlation to all of the other assets in the ecosystem. And this one qualifies. Why do they want that? It is because with that low correlation, introducing it, risk-adjusted returns go up over time. And so I do think institutions are serious about this new asset class. They may have been reticent to move in because they were hearing about the four-year cycle, and lo and behold, and I'll hats off to Chris Berniske, who has been very right in calling for, whether it's the four-year cycle or whatever, just this downdraft. And so it's closing in on the low point that many technical analysts are suggesting as the place where it should stop. These are very volatile moments at or near the bottom, but we usually do look back and say, wow, I wish I had caught that low. This V-shaped recovery has been quite significant. Not promising. I want to make sure that there are no promises here, but it does seem like the stars are aligning. Here, I just want to go through. I presented this chart at the last in the know, so we'll just give you a sense of how crazy it got a couple of weeks ago. Gold going parabolic. As a percent of M2, and many people pushed back on our use of U.S. M2. You can't get global M2 back into the 20s, and the U.S. still is the reserve currency. I don't think the message would be much different with a global M2. So you can see it hit an all-time high, higher than the Great Depression, at 1.6 versus 1.76 versus 1.71 in the Great Depression in the 20s. Today, it's at 1.54. So we do think the bloom is off the rose, but it's still at very extended levels. And we wouldn't be surprised if gold continued to come down to Bitcoin's benefit. We shall see. And also, I think Bitcoin has been hurt by all of the funds flowing into AI. That became the interesting investment opportunity. And that one has become a little shaky. So I think, these three, gold, AI, and Bitcoin, are interrelated in that way. Gold as a hedge against inflation. Look what Truflation is telling us. It's telling us inflation is resolving to the downside. It is not moving up. And there are a few things going on. Gasoline prices, until very recently maybe. Housing prices, and that's going to continue as rents come down. And even potato chips, Pepsi, Frito-Lay, Doritos, cutting prices 15%. And hims and hers, although the FTC, I think the FTC is going after them, cutting the price of GLP-1s to $49, whereas I think Novo Nordisk has cut its entry price or introductory price to $149, and then it's going to move them up to $199. This is deflation. This is deflation. And we're going to see a lot more of it, we believe. Unemployment rate. And, of course, all of this is trying to figure out, okay, what's the Fed going to say next? I was very surprised that Federal Reserve Governor Bostic said employment is very strong. And he's looking at the overall unemployment rate. And when you have 1.3 million baby boomers leaving per year, the overall unemployment rate is probably going to stay fairly low. And we've also got immigrants who are exiting, and we don't have as much of an inflow of immigrants. So the unemployment rate is going to stay low overall. But you can see what's happening to the 16 to 24-year-olds. Their unemployment rate has gone up from roughly 7% to more than 10%. The last time I presented this, it was 12.2%, but I think there were downward revisions, and we'll get to the bottom of that. We're very optimistic about GDP growth. We think we're going into a productivity-driven boom. And just reminder, the step function change in GDP growth when we had the last big technology revolution, which was the early 1900s, that growth rate stepped up from 0.6 to 3%, fivefold. And we're saying 7 to 8% by the end of the decade. So I think that's conservative, given given the technology revolution underway. And finally, this is how we think that innovation is going to play out in the equity markets, the market cap. On the right-hand side there, you can see what happened to railroad stocks as a percent of the total global equity market cap, 65%. You can see where we are now, and we think this revolution is even bigger, as I mentioned, and really just starting in its first few years at least. And you can see where we think innovation is going to go as a percent of global market cap. Again, we've just begun. We don't think AI hype is where we are at all. We do not think we're in the equivalent of the tech and telecom bubble. We're very happy that many people are worried about it. In the tech and telecom bubble, nobody was worried about anything. In fact, I'll remember clearly Jeff Bezos at Amazon, and I think this was in 1999. He, with some glee, announced on Amazon's earnings call that Amazon was going to lose so much more money in the next year because Amazon, Jeff, had decided this opportunity was so much bigger than anyone understood. And by the way, he was right. It was going to take much longer. That he had to up the capital spending budget. And what happened that day? The stock just soared. And one of our panelists on our brainstorm this week reminded me that a journalist asked Jeff, well, how do you spell profit in this new world? What does that mean? And he spelled it P-R-O-P-H-E-T. So that's how cavalier CEOs of innovation-based companies were back then, those driving the innovation. And then, of course, they paid a heavy price for that over the next 3 to 4 years. The fear in the market today, when I see Microsoft going down 12% because it's doubling its capital spending over the next year, or Amazon going down 8, 9, 10% because it's doubling its capital spending over the next year. Completely different response, completely different investor mindset. I think there's real fear out there. That was one of the reasons gold went up, fear of everything. And I just think, and this is why I wanted to do the call today, I just think we're in a completely different era, no resemblance to the late 90s. I was there. And I think we're in for very exciting times. And don't underestimate the growth rates that these new technologies are going to spur